Hello, everyone, and welcome to Credit Reporting and Lending. We got a good seminar for you today. I'm going to go ahead and share my screen with you. Okay, so let's go ahead and get started. Like I said, hello and welcome to everyone to Understanding Your Credit Reporting and Lending. We will get started and discuss understanding your credit report, filing disputes, and how your credit score impacts your borrowing capabilities. Just a quick disclosure that the information in these slides are general information and not a promise of perfection or a cure to a person's situation. Here's information about who I am and my experience and qualifications. Feel free to pause the feed to read about me. So let's get started. So a brief history on credit reports. So the credit score system has been around for 45 years and is credited with making lending less discriminatory and credit more widely available. It was founded in 1956 by engineer Bill Fair and mathematician Earl Isaac. FICO had already been working on creating a standardized and impartial credit scoring system for over 20 years. In 1989, FICO and Equifax launched the first modern credit score called Beacon, the Beacon score. In 1989, a refined credit scoring system based on their initial system was introduced and quickly became the industry standard. Before 1989, only lenders and other businesses that used the score could access it. It was this time in 1989, consumers were able to request a copy of their credit report, and sometimes for a fee. Until recently, around 2004, individuals' credit reports became free to consumers yearly at freecreditreport.com. FICO believed that the score would only confuse consumers since there was nothing to tell them what it meant, no information or anything like that. However, in 2001, this all changed due to pressure from U.S. Congress, industry, and consumer groups, and they decided to make it available to everyone. So what is a credit bureau report? The CFPB, which is the Consumer Financial Protection Bureau, defines it as a statement that has information about your credit activity and current credit situations such as loan paying history and the status of credit accounts. Most people have more than one credit report. So you have Experian, TransUnion, and Equifax. Credit reporting companies collect and store financial data about you that is submitted to them by creditors, lenders, and other financial companies, such as collection agencies and financial servicing companies. Creditors are not required to report to every single credit reporting agency. They can choose which one they want to report to. Just keep that in mind. So these are some items on your credit report that will usually stay on there for 7 years from the date of last reported. Bankruptcies, however, they will stay on your credit report for 10 years. And student loans, positive or negative, the trade lines are forever, just FYI. So some items on your credit report will be your personal information, such as your name, all names you've used in the past, current and former addresses, birth dates, social security number, phone numbers. Also, you'll find your trade lines or credit accounts, current and historical credit accounts, including types of accounts, mortgages, installment loans, personal loans, credit cards, revolving debt. All of that's on there as credit accounts. The credit limit or the amount, you'll find that on there as well. Account balances, account payment history, the date the account was opened and closed, the name of the creditor, all of that is under credit accounts. You'll also find collection items. You'll find public records as well, liens, foreclosures, bankruptcies, judgments, civil suits, overdue child support, also liens from the IRS, federal and local agencies. All of that's under public record information. Also inquiries, companies that access your CBR or credit bureau report, such as lenders, financial institutions, employers, and rental agents. So this 3-digit number called a credit score, it's meaningful enough to determine whether you can buy a new car, house, credit card, or obtain a personal loan. It's important. The system awards points based on information in the credit report, and the resulting score is compared to that of other consumers with similar profiles. It's an algorithm that they use. With this information, lenders can predict how likely someone is to repay a loan and make payments on time. In credit scoring, the credit score reflects the information on your credit report. Like I said, the CFPB states that a credit score predicts how likely you will pay a loan back or on time. That's what their definition is. Companies use these credit scores to make decisions such as whether to offer you a mortgage, a credit card, a loan, or any type of credit product. They also use it to determine your interest rate for you to receive a loan or credit card, or what type of credit limit. The interest rate is very important. Your credit score and your interest rate, they go hand in hand. It can be the difference of a high interest rate or a low interest rate. We'll get into that a little bit more. You have more than one credit score. You have 3. You will likely have a score with each credit bureau agency as well as a credit score from the lender. Sometimes you don't. It just depends on who's reporting to which credit reporting agency and what's on there. Sometimes you may not have a score at one agency because maybe the only thing that's on there maybe are medical collections or something like that, and there's nothing to draw a score from. And then when you try to pull all 3, you might just get 2. Sometimes that happens. Credit scores from lenders are risk-based lending scores. So sometimes when you access your Credit Karma or these other credit bureau agencies and other different services that offer you a credit score, those scores might be different than what the lender is pulling because they're pulling risk-based scores. Sometimes they refer to them as lending scorecards. And these types of scores are based off of criteria that the lender uses, such as how good of a customer you are with them, how long you've been a customer with them, as well as your payment history with them, as well as what's on your credit report. So they use everything. So you might, I've seen it as much as 20 points difference between a risk-based lending score and what you see on Credit Karma or what you pull from the credit bureau. So building your credit, there are several scoring methods into doing this. The score most commonly used by lenders is known as the FICO because of its origin with Fair, Isaac and Company. So Fair Isaac is an independent company that came up with the scoring method and software used by banks, lenders, insurers, and other businesses. Each of the 3 major credit bureaus, Experian, Equifax, and TransUnion, worked with Fair Isaac in the early 1980s to come up with this scoring method like we talked about earlier. The 3 national credit bureaus each have their own version of the FICO score with their own name. So Equifax has the Beacon system, TransUnion has the empirical system, and Experian has the FICO, or the Experian/FICO system. So let's talk about the impacts of your score. Your payment history. The portion of your credit score that has the most impact is your payment history. You have to pay your bills on time. Debts that are paid on time will not appear as a negative mark on your credit report. However, if you do not pay your debts on time, it will drastically impact your score. The amount owed. This portion covers your debt utilization ratio, which is the total amount you owe divided by the total amount you borrow, and or can borrow, like your limit. A low debt utilization ratio is better for your credit score, meaning if you have $5,000 in revolving credit card or unsecured debt, you should keep that debt below half of the available credit. You should not try to max it out, especially if you're not going to pay it within 30 days. The closer you are to maxing out your available credit, the greater the effects it will have on your score negatively. Length of credit history, that also will affect you. The ages of your accounts, whether open or closed, plays a sizable role on your credit score. The older and more established credit plays favorably on your credit score. Removing it could impact your score negatively. So you want to keep those older, more positive trade lines on your credit report. You don't want those to go away. They like to see older, lenders like to see older established debt. New credit. Having an assortment of revolving credit, such as credit cards, and installment credit, such as mortgages, shows you can handle different types of debt, favorably. Lenders like to see possible installment debt trade lines. So a mixture of a car loan, a mortgage, maybe 2 credit cards, and you're paying them on time. You're being very responsible, keeping your balances under half of the available credit. They like to see this. This positively affects your score, and it will positively affect the risk-based lending that the lenders give you if they're determining whether or not to lend you money. Inquiries. Multiple credit inquiries in a short period of time will pull down your credit score, as it will appear to the lender as being desperate. New inquiries will have a greater impact on those with short credit histories or short debt utilization ratios. And what that means is if you have not very much going on your credit report and you're pulling a bunch of inquiries, that will have a negative impact on your score. So how do you build credit from nothing? Well, let's talk about that for a little bit. The easiest way, some companies like Credit Karma may offer a way to build credit by using utility bills and other recurring expenses like car insurance to submit for creation of trade lines to show payment history. These are not always accepted by lenders. These may help to establish a credit score for auto approvals of credit cards, but real estate loans and some installment loans by some lenders may require additional trade lines. There are a few different ways you can build your credit. One easy way is by becoming an authorized user on someone's credit card. Make sure the person you choose has a good payment history, or it will negatively affect you also. So be careful. That's the risk you take. Also, if you are able, you can also establish credit using an eligible cosigner with established good credit for a loan. Some people do not like to cosign, because if you do not pay the bill on the loan, it will drastically affect their credit. Another way is securing maybe 2 to 3 credit cards, using them once a month and paying them off within 30 days of the due date and before the interest is charged to your card. Paying the bill before it's due will ensure you pay 0 interest while building your credit at the same time. So secure an installment loan as well. If you are trying to build credit, your initial interest rate may be high on installment loans due to the risk-based lending. However, after a year of maintaining a good payment history on all of your trade lines, you could be eligible for a refinance of the loan for a lower rate, and you would need to check with your lender for that. Some lenders will offer that. Keep in mind that it's crucial to monitor your credit to ensure there are no mistakes by credit reporting agencies or bad payments from your cosigners or authorized users. Once your credit has been established, usually after a year, you should be able to obtain your own credit cards in your name and drop the authorized user. Generally, lenders like to see at least a 1-year payment history. You may also be able to refinance your loans in your own name at that point. So if you have a cosigner, after a year, you might call the lender and say, hey, can I go ahead and refinance this in my own name? I have a job, I have income, my debt to income is good, and my credit score is now good. So, can I please go ahead and put this in my name? A lot of lenders have programs for that as well. So not all lenders report to your credit accounts to the 3 credit bureaus. Keep that in mind. Your credit score from TransUnion, Equifax, and Experian could differ based on the information on your credit report. So each lender that you establish may report to a different agency, and therefore each score is going to be different. Consumers are entitled to their credit report once a year. You can obtain this by going to freecreditreport.com. It's completely free. Sometimes they will charge for the score though. Generally, people with high FICO scores consistently pay bills on time. They keep low or no credit card balances and only apply for new credit accounts as necessary. And this slide represents how credit reporting agencies rate your credit score, as you can see here. Excellent, 810 to 850, great 750 to 809, and so on. So let's talk about correcting errors. So unfortunately, most consumers have errors on their credit report. I'm going to venture out to say, I would think it's about probably 98% of everybody's got something wrong on their credit report, whether it be addresses, inquiries, trade lines, statute of limitation errors, name errors, collections, public record errors. I have seen it all. Many errors come from same name individuals, common name Americans, Americans named after their fathers and mothers as juniors, the thirds, the fourth, etc. You will find that if you are a junior, a third, or a fourth, or have the same name as your grandmother, your mother, you might be a victim of some serious errors on your credit report. Some other errors you might see are social security numbers that may be off by one number, one digit. Also, lenders and financial institution errors. You may have a credit limit of $5,000, but the lender is reporting that your limit is actually $4,000. You know, so things like that, you would need to make sure you follow up on it and keep a good eye on. So how do we correct these errors? All of the credit reporting agencies have dispute processes, but the majority of them are automated and reviewed by robots. If it is not resolved utilizing their online process, my recommendation is to start sending dispute letters in writing and not just utilizing their online process. And sometimes you may need to do this multiple times before it's resolved. So how do you correct these errors? Obtain a current copy of your credit report from all 3 agencies. That's the starting point. Review all 3 reports thoroughly. Locate all the errors. If they are lender or financial institution errors, you'll need to contact the lender first and let them know, hey, I found this error on my credit report and I want you guys to fix that. Once they fix it and they told you it's been corrected, make sure you get something in writing stating it's been corrected. Do not forget that. That is vitally important, and save it somewhere. Obtain your, once you obtain your proof from your lender, and it's been corrected, then you can go to the credit reporting agency's website to enter a dispute and attach that proof from the lender. And like I said, you might have to repeat this process several times because a lot of them are just robots. Before it gets to somebody, you usually have to send in requests like 4 and 5 times. That's how bad it is sometimes. Credit reporting agencies have 30 days to respond to your request by law. So once that robot gets to it, it shoots out a letter saying, hey, we got your dispute. We're working on it. They responded to you within 30 days, but that doesn't necessarily mean it's going to be resolved within 30 days, just FYI. So this is an example of an initial dispute letter. Feel free to pause the feed to copy this information onto your own Word document. As you can see, it's basic. It has their address. It states that it's a credit report dispute. It's going to Equifax. You have the account information on there, and you're giving them instructions on what you want them to do. And make sure you have your name, you sign your name, your address, and also your social security number. And whatever credit report you actually pulled, make sure you have the credit report number. Once you pull a credit report, they have a number that you can use, and you can also put that on a letter as well. This is an example of a second request letter to update information on the credit report. As you noticed in the last sentence, in the first paragraph, it makes a stronger statement when you quote laws or statutes. So a lot of times when you do this, they say, okay, this is a second request. It may still go to the robot. And you might have to do this again. This process can be very tedious, and it can take a while to correct the error on your credit report. And this is an example of a stronger dispute letter. Now, because CBR agencies like to use robots for disputes, and like I said, it may take several times before this thing gets corrected. If the agency does not remove the error and it causes you to pay a higher interest rate or other damages, such as declining credit, you should consult a consumer credit attorney for legal action. They are out there, and you can Google that information. Just Google consumer credit attorneys in your area, and some will populate, and then give them a call and schedule a consultation and let them know what's going on. So this is a cease and desist letter. So cease and desist letter has a legal statute based upon the Fair Debt Collections Practices Act, Section 805. The Fair Debt Collection Practices Act applies to both the agency and to attorneys who collect 2 or more debts per year. So this law does not apply to the original creditor. However, many original creditors will honor your request to not be called. But it doesn't apply to them. So when a collection agency receives a cease and desist letter, they may move the account to legal status. And this means if they intend to sue you, if they can't collect on the account because you sent the cease and desist letter, it will prompt them to bring suit immediately. Some collection agencies are like that. So just kind of FYI on that. If there is an alternative way to stop being bothered by their calls, like maybe using an answering machine, your voicemail, just send it to voicemail, or one of those robo caller blockers, that's probably the best thing to do first. If there is no alternative, then go ahead and send the cease and desist letter. You can send that letter via certified mail with a return receipt request. Keep a copy of the letter for your files. The letter may take a couple of weeks to work, so you may still get some phone calls. It's a way through the collection agency system. It takes a little bit of time to get through the collection agency system before the number is taken out. So just keep that in mind, that you may still receive some phone calls. But this is an example of a cease and desist letter if you need one of those. So this is a book that I read, and it's one of the best books I've read regarding repairing and establishing credit. It goes into explicit details and step-by-step instructions on what you need to do to increase your score, build your credit, and dispute erroneous information. It provides great example of letters that I have used that have actually worked, and they even give you a lot of different tricks and tips and tools on establishing your credit, and even to be able to bypass robots to get your letters to actually go to an actual person. I did try that one, but when I was trying to get something corrected on my credit report, it still did not work. However, you may have to just continuously try different tips and tricks that they have in there. But this is a really, really good book if you're trying to repair your credit. So the better your credit score, the lower you will pay in interest rates on loans and credit cards. This is especially true for real estate lending, because 720 plus credit scores will get the best mortgage rates, and therefore they'll pay less money in interest at the end of their loan terms. These are considered A and A plus borrowers, and that's where you want to stay. In this example over here, On the screen, it shows just how a credit score can affect your interest rate and your bottom line. So if you're an A+ borrower, you get an APR of 2.3 versus a B or C borrower with almost a 4% rate. Your bottom line is about $100,000 more by the time the loan is paid off for a real estate loan. So it's definitely drastic, and it's definitely a good idea to make sure you repair your credit before buying a house, if at all possible. So the lower your credit score, the higher your credit card variable interest rate would be. So this works the same way with credit cards. The better your credit score, the better the interest rate and credit card offers, such as annual fees, benefits, rewards, and promotions. The average credit card interest rate in 2018 was 17.56. It's not uncommon for credit card interest rates to be very high. However, the higher your credit, if you fall into that A+ category, you could find yourself maybe with 9, 10, 11% credit card rates. So risk-based lending. Risk-based pricing occurs when lenders offer different consumers different interest rates or other loan terms based on the estimated risk that the consumers will fail to pay back their loans. Credit scores are the primary way lenders can evaluate your credit worthiness, such as your debt to income ratio, employment status, credit worthiness, outstanding debt, debt utilization. These are often referred to as compensating factors. These are also used in real estate lending, as well as if you're trying to buy a car. This is called risk-based lending. They use all of this in order to determine what kind of interest rate they want to give you. Some lenders call it a credit score, or I'm sorry, some lenders call it a scorecard. Risk-based lending can also be referred to as that. Risk-based pricing protects lenders from losing money on their investment, but it's not ideal for a lot of consumers without a solid credit profile. So just keep that in mind. If you have high risk credit or medium credit, your interest rates could range from 8% to state level interest rates. And sometimes state level can be 30%. In this example, at 8%, you can see how much interest you would pay on a $10,000 loan for 8 years. The lower the rate, the less interest you will pay, and this is based on credit worthiness. So in this example, you have a $10,000 loan at 8%, the interest you're going to pay at the end is more than half of that $10,000 loan. So once again, the lower the rate, the better the score. I would like to thank you for tuning in and listening to Understanding Your Credit Report and Lending. I hope this seminar was helpful and you are able to utilize the methodologies and tips when navigating through your credit report. The Everyday Daily Real Adult Nonprofit Learning Organization conducts several other seminars for the everyday adult navigating through life's challenges and processes. Please reach out to me via phone or chat if you'd like any additional information. And your contribution will allow us to continue to provide free education to our young adults and local communities, as well as be utilized to provide educational material and information to young adults everywhere while they're navigating through their learning process and development process in their adult life. Please visit our website for additional information about the organization and our mission, as well as learn information about our teacher and our board of directors. And if you have any questions, please feel free to reach out to me. And you guys have a good day.